All right, what whole life insurance policy should you choose? Only if I knew that option was available before I started a policy. Today, we are going to go through what I like to refer to as a hybrid whole life insurance policy, which is actually a made-up term. I made it up. There's no such thing as hybrid whole life. What I mean when I say that, we're going to look at specifically an L95 policy. Why I use the term hybrid is when you look at a traditional whole life insurance policy, like a whole life 100, a whole life 99, what are those types of products specifically geared for? Strong long-term performance. What's the drawback? If you go back to the traditional whole life insurance videos, what's the drawback to those? Premium dollars do not show up in cash value in the first and second year. They're gone. The company overcharges me up front. So the drawback, weak upfront cash value, but strong long-term cash value, and the ability to keep pumping money in for a long time if I want to. On the flip side, I've got a high early cash value product, which credits me the bulk of my premium upfront, very cash rich from day one. However, what's the drawback to a pure high early cash value policy? Long-term performance isn't that attractive, right? I get my money up front, but they spread the expenses out over the life of the policy, and they're actually a bit higher. So a hybrid whole life insurance policy is right smack dab in the middle. And really how it works is if I'm going to pump money into a whole life policy, an L95 for example, for a long period of time, it'll underperform compared to a traditional policy. If all things are equal, meaning the design's the same, company's the same, all that good stuff. However, a unique advantage one has with these products is if someone says, hey, my goal is to max fund this policy for 5 years and then stop. 10 years and then stop. I'm very intentional about maximizing the internal rate of return. Maybe after 10 years, I'm going to keep paying the minimum premium, but I'm just going to stuff it early on and then take my foot off the gas a little bit. You will get strong upfront cash value because of how the policy works. I'm going to go through the details in a second, but then also strong long-term cash value as well, which is a nice advantage where I can capture the best of both worlds there. Also, because this particular type of policy exists with Guardian, what a lot of people like to do, we'll see this frequently where someone says, hey, I want the ability, Steve, not commitment, but ability to pay up to $100,000 per year. I do want to have access to the majority of my capital that I pay in over time. So what they'll do is commit just to the minimum premium only, which in this particular case would be what? $10,000, and then 100% at their discretion, they'll throw money into PUAs just on an unscheduled basis, which is nice. So how this product works, to be very specific here, whatever your premium is, let's say it's $10,000, what you will find is that zero shows up in cash value for the first year only. Beginning year 2, that minimum premium begins to come back to work for you. You see it in cash value, begins to compound, gets better and better. Now, similar to a traditional whole life insurance policy, the company is mainly overcharging us for the cost of insurance in the first year. Now, PUAs, like any and all policies, can be plowed into the policy, therefore accelerating the cash value growth. In this particular example, we're going to look at something like this, 10,000 in the base, 90,000 in PUAs, with a $100,000 MEC limit. But first, we will look at just a $10,000 base premium to help better understand how the base premium actually functions. So let's get on into it. Here we've got an L95 policy, hybrid whole life product with just a pure $10,000 base premium. Nothing fancy about this one bit as we look at it. So here we go. Where's the money going? Base premium, $10,000. That buys you a whole life death benefit of just under $510,000. As we look at the actual charts down here, what do you notice? First year, you make the $10,000 payment, $10,000 base premium. What does this column again represent? We've covered this in each of the videos. If you have not seen any of the prior videos, this column, base guaranteed cash value, represents what the cash value buildup is based on only the base premium. So if you have a policy where you're adding money into PUAs, this column will not reflect that. Reflects only the base premium and only the guaranteed rate. In this particular case, being 3%. So what I'd want to know here is, okay, how's the policy function? I've got the $10,000 payment going in. Scroll your eyes to the right. Net cash value, there's your money column. Right off the bat, you have what? $351. Not quite zero, but very close. The next year, however, $10,000 is made in a pure premium payment. And what do you notice? You get all of it back and a little bit more. But then the following year, you get a little bit less. Eventually, it picks up the pace again. If I look down here, it takes between 13 and 14 years to break even, just to get my money back, which is common for most whole life insurance policies when I'm paying just pure base premium. A higher cash value product might be a little bit different, and some limited pay products are different. But here, it still takes a long time because it mirrors a traditional life insurance policy in that respect. However, if you said, hey, I want to max fund this thing, I'm not really interested in just paying a premium, I'm interested in the cash value benefit and the life insurance, but the cash value is why I'm doing this, how do I really maximize this thing? And here's the answer, or one of the answers. So, get to have too much fun talking about life insurance. Here we've got 100K payment. Where's the money going? Here's the premium piece. There we go, $10,000. Paid up additions rider, PUA, right down here. Now, what I want to touch on here is the full 90 grand is not going toward PUAs. Your premium, $10,000, gets you the exact same whole life insurance death benefit we saw in the last illustration with just the pure 10K. Then we've got this target additional benefit of another $1.5 million. What that is a term insurance rider. The purpose of a term insurance rider is that it is a cheap, if you don't like the word cheap, a cost-effective strategy to raise the death benefit, which raises the MEC limit and allows me to plow more money into PUAs. So let's take a look at the numbers down here. Here we've got a 5-pay. A lot of people are attracted to this, where I can pay into it for 5 years and I'm done. I can pay into this. This is based on a 40-year-old male for 2 or 3 years, then I'm done altogether. Well, here's 5. Net cash value, when did you break even? Year 5 in this example. If you've watched any of our old videos from last year or years ago, you likely remember this type of product, the hybrid series, where it broke even between years 3 and 4 with the same company and product. Why it's later now, even though the base premium and everything is the same, is as a result of that 7702 industry change, most companies have increased their PUA rider fees, which as a result have pushed the break-evens back a little bit. The companies have had to remain profitable, and that's a good topic for another video. But here's my cash value over time. Looks good as we continue to scroll down. So again, the advantage to this policy, what a lot of people will do is say, hey, I'm going to have a policy, I'll commit to that only. That and the term rider, which was about $500, so I commit to $11,000, and then at my discretion, I can just throw another $90,000 into PUAs on an unscheduled basis. So I commit to the minimum, add more at my discretion. Very exciting. So let's look at one different variation of this. So here's another version. We're going to look at the guarantees as well. And I made one tweak to this to improve the cash value performance. We actually pushed the base premium down to a little under $9,100. It's not much difference, but here's what I want to touch on. Guaranteed values, dividend values. What do you notice here? Guaranteed values, 100K per year going in for 5 years, and I stop breaking even between years 8 and 9. Annualized internal rate of return, annual IRR, again, isolates what you are earning year over year. So, for example, the guaranteed rate is 3% here. Do you ever see an earning rate of 3%? No. When it tops out at 2.57%, what that means is if I just simply measure how much did my cash value grow by this year, what's the actual rate based on the guarantees alone when it grew from 509 to 522, almost 523, that's a net internal rate of return of 2.57%. That's the net number. So important. We've been showing this in almost every video when we look at numbers now. The reason why is with whole life insurance, there is so much confusion and so much frustration. I can feel it in people's voices when they talk to us or when they text me all the time. Not with us, fortunately, because I try and make this transparent, though it has happened in the past. The point of frustration is when individuals are led to believe or told, look at this dividend rate with the insurance company. You've got this great earnings rate, here's what it will do, or they're not even told what the actual net earnings rate is, whatever it might be. They get frustrated because people simply want to know, what is my cash value growing by? That way I can make an educated decision. Or I'm already sold on it. Just tell me what the numbers are. Don't play a stinking game with me. So that's based on the guarantees. Here we go. Based on the present dividend rate. Quite attractive over time. There's my internal rate of return on an annual basis. Average represents what I averaged out over a certain number of years. So if I take a look at this guy, by year 20, I'm earning just over 4.7 year over year, and almost at 4% on the average internal rate of return. So this is a 5-pay here. I could fund shorter or longer if I wanted to, but great option to be aware of. Why I like it so much is I like the traditional whole life insurance model, except for the first 2 years. But I like the traditional model where I can keep paying in and I experience strong long-term internal rates of return, strong long-term performance. This guy gives me the same thing, but I get more cash value up front, which whether I use it or not, it's an asset on the balance sheet, whether it's business or my personal balance sheet, but I've got access to that capital for opportunities. Being in business, that's much more valuable than another 0.5% a company is going to give me. So I hope you enjoyed this one. I always love talking about this stuff. If you did, please hit the like button. Please subscribe for more. It does help us, and I will talk to you soon. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.